If you really want to understand how a financial crisis begins, don't look at Wall Street. Don't look at interest rates or charts or anything economists like to argue about. Look at shopping carts. Look at checkout lines. Look at ordinary people on an ordinary day, making completely ordinary purchases that, when multiplied by 100 million, quietly prepare the explosion long before anyone hears the fuse. And today, November 29, 2025, that fuse is burning faster than anyone realizes. This isn't a holiday shopping spree. It's the final act before the next major economic downturn, and millions of Americans are unknowingly writing themselves into the first chapter. Let me show you why. Right this moment, as you're watching this video, Americans believe they're doing something clever. They're elbow deep in Black Friday deals, racing through aisles, refreshing online carts, grabbing limited time offers, on TVs, laptops, kitchen gadgets, many of which were quietly marked up last month just to be slapped with a discount banner today. They think they're outsmarting the system. But what they don't see is the truth. They're loading a financial round that's going to fire directly into the heart of the US economy in 2026. This isn't just Black Friday. This is the final consumer debt surge before the system hits a structural breaking point. Across the country, the scene is always the same. Parking lots overflowing before sunrise. Crowds wrapped around Best Buy, Target, Walmart. Online storefronts lagging from traffic. Countdowns hitting 0. Only 4 left. Price drops in 2 hours. The chaos looks harmless. Festive even. But here's the part most people never acknowledge. They're not paying with cash. They're paying with credit that's already stretched to the limit. Some are swiping cards with only a few dollars of available balance left. Others are leaning on buy now, pay later apps that create the perfect illusion that a purchase costs nothing today. Americans are not buying with disposable income, they're buying with tomorrow. Let's look at the numbers. The Federal Reserve confirmed that by the end of 2024, U.S. credit card debt reached $1.14 trillion. That was the real number, not a projection. Now, with 2025 closing out, we're drifting toward $1.2 trillion, and Black Friday is accelerating that climb. What does $1.2 trillion actually mean? It means the average American household is lugging around $6,500 in credit card debt, not counting mortgages, car loans, medical bills, or student debt. And with interest rates averaging 22% APR, this debt pile doesn't shrink, it grows like mold in a dark room. Even those who believe they're managing it with minimum payments are sinking month after month. Now add Black Friday. The typical family adds $400, $600 to their balance. For someone already drowning, that extra $500 becomes the final weight pulling them under. Because that $500, when paid back via minimum payments, will eventually cost more than $1,000. Not someday. Not eventually. Mathematically, inevitably. The debt bomb isn't hypothetical. It's already armed. Black Friday 2025 is the finger hovering over the trigger. You may ask, but people always use credit during the holidays. Why is this year different? Because this time the cracks are showing first. Credit card delinquency rates, accounts 90 days overdue, have climbed to 3.1%, the highest since the aftermath of the 2008 crisis. And this is happening without a recession. Meanwhile, personal loan defaults are up 15% from last year. Auto loan delinquencies are at their highest level in 7 years. The New York Fed reports serious auto delinquencies are accelerating, not stabilizing. These aren't reckless spenders. They're normal Americans who are simply underwater. And here's what really matters. Credit card bills are never the first bills people skip. People keep their rent current to avoid losing their home. They pay the car note because they need transportation for work. Credit cards? Those are the first domino to fall. So when credit card delinquencies hit crisis levels, it means everything before the credit cards has already been squeezed dry. These are Americans with no fallback, no safety net, and no margin left. And they're still shopping today. Now, here's the timeline that's already in motion. December 2025 Black Friday purchases finally appear on statements. Millions see their minimums jump from $150 to $250 or more. Most will shrug and say, "I'll deal with it in January." January 2026 January arrives, the cruelest month in personal finance. Bills hit. Bank accounts are low. Holiday expenses collide with real-life surprises. Millions suddenly realize, I can't pay this. Some miss the payment entirely. Others send a partial amount. Either way, the clock starts ticking. February, March 2026 those missed January payments turn into formal delinquency. 30 days. 60 days. 90 days. Late fees stack. Interest compounds. Credit limits vanish. Cards get shut off. And here's the macro impact. 70% of America's GDP comes from consumer spending. Cut off consumer credit, and you cut off the bloodstream of the US economy. April 2026 banks panic. Charge-offs spike, debt they'll never recover. Quarterly earnings reveal massive losses. Investors react exactly the way you expect. Fear. Sell-offs. Pressure. May-June 2026 banks do what banks always do in crisis. They slam the lending door shut. Credit lines slashed. Loan approvals frozen. Mortgages harder to get. Auto loans denied. Responsible borrowers get punished alongside everyone else. Retailers miss targets. Layoffs begin. Laid-off workers default even faster. Defaults cause bank losses. Bank losses cause more lending freezes. A tightening spiral, turning faster each month. By mid-2026, we reach the moment where the system stops reacting and starts breaking. Just like 2008. Back then, the weapon was subprime mortgages. No income loans. Teaser rates. Zero down. People buying homes with money they didn't have. Banks pretending everything was safe because home prices never fall. We all know how that ended. Lehman collapsed. Bear Stearns vanished. The global financial system stood inches from total failure. And now, we're replaying the same script, only with different actors. Today's toxic product isn't subprime mortgages. It's subprime consumer credit. Overextended credit cards by now, pay later loans approved with almost no underwriting, personal loans pitched to desperate borrowers. BNPL alone has $300 billion in outstanding loans, with delinquency rates hitting 30%. 10 times higher than credit cards. These loans are already being packaged and sold to larger financial institutions, exactly how mortgage-backed securities poisoned the system in 2008. When the defaults hit in early 2026, the damage won't stay contained. It never does. And behind everything lies the most predatory trap of all: minimum payments. Charge $2,000 on your card at 22% APR. Make only the minimum. You'll pay for 7 years. And you'll hand over more than $4,200 in total. This isn't an accident. It's a design. Multiply that trap across tens of millions of Americans, layer on Black Friday spending, and the system reaches its breaking point. And that's where we are today, standing on the exact threshold where everything tips. When consumer credit fails at scale, the economy doesn't slow down. It stalls. It seizes. It collapses. And unless something changes, 2026 is shaping up to be the year that the system finds out exactly how much weight it can no longer carry. Consumer spending accounts for nearly 70% of America's GDP, and that isn't just an interesting statistic, it's the bedrock the entire US economy rests on. Every dinner bill, every phone upgrade, every car financed on a 72-month note, every new streaming subscription flows upward into corporate earnings, which support payrolls, which produce income, which then circles right back into more spending. As long as money, cash or credit, is circulating, the engine runs smoothly. But once consumers run out of runway, once the credit lines snap shut, the entire machine grinds to a halt. That moment is coming fast. When millions of Americans hit their credit limits in the final weeks of 2025 and begin defaulting in early 2026, they won't slow their spending, they will stop completely. Not because they suddenly became frugal, but because their cards will decline and their checking accounts will be empty. When that happens, consumer spending doesn't dip a few percentage points, it collapses 10% to 15% in a matter of weeks. Retailers across the country spent the last year planning for a typical first quarter. They stocked shelves, scheduled employees, set advertising budgets, and placed inventory orders based on historical data. They assumed consumers would behave like they always do. But Q1 2026 won't look anything like past years. Consumers won't have the credit capacity to purchase anything beyond the bare essentials. Retailers will post widespread earnings misses. Share prices will fall. Bank lenders, already nervous from rising delinquencies, will begin restricting credit lines to protect themselves. Corporations will respond the same way they always respond when profits sink. They will cut costs. And cutting costs means laying workers off. Now imagine what happens next. The very people losing their jobs are the same people who were already struggling to keep up with minimum payments while they were employed. A layoff turns late payments into immediate defaults. Their credit cards fall behind first, then their auto loans, then their rent. Each default deepens the bank's losses. Those losses cause banks to tighten lending further. Tighter lending means fewer consumers have access to credit. Less credit means less spending. Less spending means more layoffs. More layoffs create even more defaults. The entire system enters a feedback loop, a self-reinforcing downward spiral that becomes impossible to stop once it begins. That spiral officially begins in Q1 2026, fueled by the debt Americans are piling onto their cards right now during Black Friday 2025. This isn't theory. It's arithmetic. When credit is maxed out, spending falls. When spending falls, the economy contracts. When the economy contracts, defaults increase. And when defaults increase, the financial system breaks under the weight of its own structure. The numbers already tell the story. Delinquencies are rising before the crisis even begins. The cliff isn't approaching, we're standing on the edge. To understand how this unfolds, follow the timeline. December 2025 arrives and Black Friday purchases move from pending to posted transactions. Millions of Americans will open their statements and confront balances that are hundreds, sometimes thousands, of dollars higher than expected. Their minimum payments jump sharply, blowing apart already fragile budgets. Many cardholders will do what feels rational in the moment, pay a fraction of the bill and assume they'll figure out the rest later. But January has always been the most difficult month for household finances, and January 2026 will be the worst of all because people will be going into it already behind. When those bills come due in January, the first wave of missed payments will hit. This time, the people missing payments won't be fringe cases or irresponsible spenders, they'll be the front edge of a national surge in delinquencies. By February and March, those missed payments turn into 30-day, then 60-day delinquencies. Credit card companies will report them to bureaus. Credit scores will fall across the board. Consumers will lose access to their credit lines entirely. For millions of households, credit cards aren't used for luxuries, they're survival tools for groceries, gas, school costs, and unexpected emergencies. With no cash and no credit, they'll have no ability to function financially. By April 2026, the bank's quarterly earnings reports will expose the true scale of the crisis. Charge-offs, debt officially written off as uncollectible, will spike to levels not seen since the 2008 meltdown. Analysts will downgrade bank stocks. Investors will flee from institutions with heavy exposure to consumer credit. The first companies to face real trouble will be those most concentrated in credit card lending. Discover Financial Services stands out as one of the most vulnerable. Their portfolio is heavily weighted toward subprime borrowers, people with lower credit scores who default at far higher rates when economic stress hits. When defaults surge in Q2 2026, Discover may find itself in a solvency crisis. Their stock could collapse, borrowing costs skyrocket, and regulators step in. Synchrony Financial faces its own trap. They issue store-branded credit cards for major retailers such as Amazon, Lowe's, and TJ Maxx. When consumers default on those cards, Synchrony suffers. When retailers reduce their financing programs because fewer customers qualify, Synchrony is hit again. It becomes a double failure, a structural implosion. Meanwhile, major retailers themselves, especially department stores such as Macy's, Kohl's, and JCPenney, are operating on razor-thin margins. They've been closing stores for years. Nearly 40% of their sales depend on consumers using credit. When millions lose access to credit in early 2026, those retailers will experience immediate sales declines of 20% to 30%. Most don't have the liquidity to withstand that. Several iconic names will likely file for bankruptcy by mid-2026. By now, pay-later companies like Affirm are sitting on an even more precarious ledge. Their delinquency rates hover near 30%, 10 times higher than traditional credit cards. Their stock has already collapsed from its highs, and when BNPL defaults surge in Q1 2026, Affirm's business model will implode. Their funding will evaporate. Banks will call in their credit lines. Cash flow will disappear. It's the same pattern that destroyed Lehman Brothers, just with different products. By Q3 2026, Affirm will likely be bankrupt or sold off cheaply in pieces. Here's the part most Americans don't understand. Even responsible borrowers will be dragged into this collapse. You might have never missed a payment. Your credit score might be excellent. None of that matters when banks panic. During the 2008 crisis, banks cut credit limits by nearly 30% across the board, even for perfect customers. If you have a $10,000 limit with a $2,000 balance and your lender suddenly cuts your limit to $4,000, your utilization jumps from 20% to 50%. Your credit score plunges not because you did anything wrong, but because the system rebalanced itself at your expense. And when you try to get a car loan or mortgage in the second half of 2026, you'll find the door nearly closed. Higher credit score requirements, larger down payments, Higher interest rates, stricter underwriting. You'll be locked out along with everyone else. So how do you protect yourself before the storm hits? Start now. If you used your credit card for Black Friday purchases, pay it off before January. Sell the items if you must. Use savings if you must. Do not carry holiday balances into 2026. Reduce your credit utilization below 30% before the banks begin slashing limits. Build 6 months of cash reserves in accessible accounts because credit cards will not be an emergency fallback once the freeze begins. Avoid buy now, pay later entirely. The 30% delinquency rate is a flashing red warning light. And above all, do not let a temporary discount seduce you into long-term debt. That $600 television can cost you $1,500 in interest, a damaged credit score, lost opportunities, and years of rebuilding. The lenders know this. Retailers know this. BNPL companies know this. The trap works because consumers don't run the numbers. The pattern is exactly the same one that led to the 2008 crisis: predatory lending, securitized bad debt, institutional exposure to collapsing credit, and an economy built on easy borrowing. The crash of 2026 is already on the path. The math is locked in. The timeline is moving forward. The only question is whether you will be one of the millions crushed under the avalanche or one of the few who step aside before it hits. Those Black Friday deals weren't bargains, they were the down payment on the next financial collapse. And the bill is already heading your way.